All right, welcome everyone. Good morning, afternoon, evening, wherever you are tuning in from around the world. Welcome to our next Ask Me Anything session here on Crowdcast with Techstars. I am Casey and I'll be helping to moderate the event and guide you along. And if you have any questions throughout the event, go ahead and put them in the chat or in the Ask a Question box below us. If you are tuning in from our LinkedIn live feed, go ahead and add questions over in that chat and I will check there throughout the event also. So today we are going to be talking about metrics around your starting up and what really matters. So this is a big topic, so get ready to ask anything that you need to know about metrics and building your startup. We are joined by the co-founder and CEO of Chargebee, a Techstars Global Network partner, Krish, and I will pass it over to Krish to give a little bit of intro about himself.
Thank you so much, Casey. Really appreciate it. Hey everyone, excited to be here. My name is Krish, Subramanian, co-founder and CEO of Chargebee. So Chargebee is a subscription management and billing platform that is agnostic of CRMs, accounting systems, and payment processors. And we streamline billing and payments for high growth SaaS and SaaS-like businesses, primarily subscription businesses. And we serve customers in 53 countries, most of the customers, more than 3,000 plus paying customers, and processing close to $4 billion of ARR of our customers in North America, Europe, and APAC. That in a gist, and we maybe because we are going to talk about the context of the business, I think that where we are matters. So I'll add a little bit more color to that. We are now a team of close to 500 people spread across 4 continents. And I'm right now in Chennai, but there is also a 50-member team in North America, and then about 25 people in Europe, and a few people in Australia. So that in the gist is about the team as well.
Great, awesome. All right, I'm going to go ahead and get into some of our topics that we'll start with. And I see that we have our feed live on LinkedIn, so hello over there if you're tuning in. Great to have you with us. All right, so Krish, you recently wrote an article on the Techstars blog about startup metrics and what you should be tracking when you're starting up. And you mentioned the startup 3 stages of the SaaS startup evolution. So what are the 3 stages of the SaaS startup evolution?
All right, thank you. I'm going to borrow this from Brian Balfour framework, and I have put together a few slides, if that's helpful to take everyone through. And thanks everyone for I'm just looking for screen share. Sorry about that. All right, this is my screen. Okay, I'll quickly take you through this. So the way we define this is going to be 3 stages, which is a 0 to 1 million stage.
Oh, I don't see the slide. I don't see the slides yet.
Oh, you do not? Okay. Screen. Do you now see the screen?
No.
Okay, right. Maybe we'll talk through it. That's fine.
If you wanna have someone send them to me, I can share them as you talk through them.
Okay. I think Shweta is already on the call. Maybe she can email it to you. Right, no worries. I think the concepts are the same, which is our 0 to 1 million is our product market fit stage. The 1 to 10 million is what we call as the product scale fit. And then the next stage, the 10 to 10 million and above, is a product growth fit. And Brian Balfour talks about it as the 4 fits framework. There is a very popular blog in HubSpot as well, where he talks about the market and the product fit, and then the product and the channel fit, that is essential, and then the channel to the business model fit. Right? And then it connects back to the market. The business model connects back to the market. Yes, that's the one. The next slide, please. Thank you. So in each of these stages, right, there is something that matters when we are going through these iterative process of finding this, the product market fit and product channel fit. I think this context is important when we think about what should we measure, right, at each stage. And the most important one, right, which is when we are all in the very early stage, it's all about the problem validation and survival are the most important things. The second part is the repeatability And the third one is the health metrics. Those are the different stages you start measuring different things. Casey, if you don't mind repeating that question, I think that will be helpful so I don't deviate too much from the question. You're on mute.
There we go. I wanted to stay so quiet, I was to mute. What are the 3 stages of the SaaS startup evolution?
Right. I think, okay. So we just covered this with respect to the previous slide, which is the 3 stages is how we define that and what matters in those stages. And we have more details that we will cover subsequently in terms of what to measure in each of these stages.
Great. Let me go ahead and make the slides small for now as we keep going. And so what is product market fit? So this is something that I think we get asked a lot on about events from a lot of CEOs and a lot of founders. What is product market fit?
Sure. I'll talk from our experience, right, more than giving a generic answer, because this topic is done to death in terms of the definitions and all of that. But when I think about our own journey, we bootstrapped the company through the first 2 years, and then we raised capital from investors. Later, we have raised over 100 million. But initially, we raised, I think, less than $1 million angel plus the first investor, subsequently another 5 million. But the truth is, even through that phase of raising money, after bootstrapping the company and then launching the product, and then even after raising money, till we got to the first million, somewhere it didn't feel right. That is what I mean by that is, do you have the flywheel going, the high quality revenue that is coming in, and is that at a level where you are able to confidently say if 10 customers show up at our doorstep, they are trying out the product, I can predictably say, okay, at least 5 of them have similar problem, and we already have the product exactly for the problem, and we are able to get them to that wow moment, right? Initially, we could not say that at all, because we were, as first-time founders, one of the things we were trying to do was to get as many customers as possible, because we were doing inbound. We picked inbound as our channel where we would try writing blogs, hang out in forums, get customers, and then subsequently do try out AdWords. But inbound is the engine with which we were trying to build. And the challenge, the advantage of inbound is you can be anywhere in the world, and then it's beautiful when it starts scaling. You will be able to make it programmatic, where you are able to get a lot of leads. But the biggest challenge with inbound is qualification, because it could resonate with anybody. How do you know that this is the right customer, which requires us to have a strong hypothesis? To give context of where the problem was, subscription billing or somebody needs recurring payments is a broad topic, because it's applicable to newspaper industry, digital media, SaaS companies need it, e-commerce companies need it, and anybody could be showing up at your doorstep. How do you know that this is the right customer unless you have a strong hypothesis and ways to disqualify them? And very interestingly, we attracted a lot of early stage companies, which were agencies which needed to send recurring invoices, but they were looking for just 10. They can only charge 10 clients, and they were really not trying to build a high growth business like a SaaS business. So which meant that their expectation of what they were looking for those keywords and what we were trying to have was a mismatch. And this is where the product we can trip, where in the initial excitement of trying to find any customer, we tend to onboard anybody. And then what happens is, very quickly, you have customers who are going to ask for features, because everybody is a customer. Even if you have like a $49 product or a $99 product, they might actually start asking for features. But the problem is, if you do not get that high quality, repeatable, and that right type of customer that you have in mind, you can quickly trip in terms of pulling the product direction in different ways. And this is where making sure you're iterating on your pricing and making sure you are aligning with the value metrics of what the customer is looking for and what you have. We need to keep our eyes peeled with respect to this particular aspect, which is why I would actually, I think this leads to another question that somebody had asked about what metrics I shouldn't be tracking early on. which is if you start tracking, okay, what is my CAC, what is my, how many leads am I getting for the payback period and all of that, those are wrong metrics to measure, especially in the early days. I would reverse the problem to actually say, think about why, who's actually signing up, why are they signing up, how did they find about us, and things like that. So long story short, if I actually think about reflect on our own journey to think about product market fit, the repeatable aspect of somebody who's you are able to repeatably bring somebody showing up at your doorstep for the problem that you are solving for, and they are able to discover value through your product, and you are able to do that repeatably. And that the repeatable process, the motion of somebody discovering your problem resonating with that particular some segment of market, and that gets this motion in place, is what I would define as a product market fit.
Great, awesome. And so, when going for product market fit, how do you go about finding ideal customer? Should I get feedback from them early on?
Right. Can we move forward a couple of slides? Slide number 4. I think that may be helpful. Yes. Can we also expand all the? Thank you. I'm really sorry that I'm asking you to this. Can you also click twice? I think there are 2 more. Yes. Thank you. So the way I would, so we tried to write down what are those questions, what are those things that we should definitely validate in this particular stage to know that what we are building resonates with the customers, and how do I validate this? So when it comes to measurement, right, there are 3 ways in which I would actually look at it, right? Market and channel, product, and business model, right? Most of the time we tend to focus a lot of effort in problem validation and our product, which is right, which is, okay, how much value do they assign to the problem, and is the particular problem that we are trying to solve, does it resonate with the customer, right? Those are things that we all do. Most entrepreneurs do that really well. But the part I would also encourage you to think about from the very early days, especially if you are a founder who is engineer, but go to market is something if you are learning, I would encourage you to test if the problem resonates from that particular market and channel of that customer, and what am I really replacing? This honest take is very important. Early on, Axel Partners, one of our investor, used to ask the same question almost repeatedly. Whenever I say, okay, hey, we got this customer, Soylent used to be Chargebee customer for the first 5 years of their journey. And whenever I would declare a win and then tell him excitedly saying, hey, we got this customer, and then one of the board members used to ask, okay, so what were they using before that? What did you replace? And why were they looking at you? Again and again, the same first principles questions are extremely important for every win. And even for the customers who are evaluating you, it's very important to ask the same questions to understand this, because this is what we are going to make repeatable later on and scalable later on. So it's very important to ask those same first principles question. And one mistake we did in the early part of our journey was not to charge customers, even though it's very ironic, right? We have a billing product, but we used to, in the excitement of trying to get customers in and then letting them try the product and then get them using, we did not aggressively test if they are willing to pay. And more importantly, another one I would urge you to do is test the pricing, which is deliberately thinking about what price point is attractive to what type of customers. Again, to go back to the previous example I was mentioning, agencies which were thinking about, I only want to send 10 invoices, they actually discovered us because we used to have a 10 invoices premium tier. And the problem with that was premium was, it was attracting a wrong type of customer, which was not most suitable for our product long term. But they asked for features like, hey, can you give me more templates in invoices? And they were comparing us to a $15 fresh books kind of an accounting software, the invoicing software. And they really did not need a subscription management product. So the mismatch was because we had an entry-level freemium price, and they thought they were always going to use it for free. But we thought it was freemium and they were going to upgrade after the certain usage and all of that. And so if you get your pricing wrong, this is a problem. That is why you don't want to make the mistake of trying to get it absolutely right, spot on. But thinking about it as an iterative process where you can, just like your product roadmap, you should also think about experimenting with pricing for the channel that you are trying to get your customers is very, very important. If you are someone who's actually picking up the phone and then selling to the customers, also still test the price, right? And deliberately write down the questions that you want answers for, especially early stage, which is why a lot of people insist that founder should be the first salesperson. Simply because you should be listening to those calls, even if you are writing code and you are hiring somebody to sell, then definitely sit and listen to those calls.
Awesome.
Casey, is this going in the right direction that you wanted? Right. Feel free
definitely.
to interrupt. And
yeah, I think this is a great way to start out. We have a lot more. We have some specific audience ones that we'll go into now, but we'll keep these slides, up here for now for people to see. And then as we need to touch into more content, we can go ahead and go into that. So we have a bunch of questions coming in, and I also see them on LinkedIn, so I'm trying to copy them over. So now that Krish has talked a little bit about the metrics, product market fit, finding your customer, we'll go ahead and start answering some of your questions about that. So one of the first ones from Rebecca is, what quantifiable metrics are the ones that matter most to venture capitalists?
Right. I'm assuming that most companies right now are in the product market fit stage, right? And then launching, right? Tech stars. It's very interesting. That is, you can almost qualify a venture capitalist by the questions that they also ask. Because in the very early stage, if they are asking these, the metrics that you would want to track are very basic for the very early stage, right? Which is something like, hey, how many qualified leads are you getting, right? Actually, can you skip through a couple of slides, Casey, if you don't mind? Stage 1. I have a few metrics that we have written down for this. One more slide down. Yes, right. Yeah, so these are metrics that you definitely don't want to measure, right? And then we'll go to the previous slide to look at which metrics to measure, right? Because it's too premature to measure LTV or churn rate or CAC payback or all of that, right? So let's focus on what to measure, and then we'll look at it. So one is MRR, right? Definitely you want to know how much monthly recurring revenue are you making, because if you're charging customers, you should measure that. Number of qualified leads is something that I would definitely ask you to look at, because there is one thing early stage is very important to solve, is solving for demand, right? If you can create demand, the rest of the problems can be solved one step at a time. So number of qualified leads is something that I would encourage you to do that. And I'm deliberately using the word qualified leads and not just some leads, because then you will need a hypothesis of what defines a qualified lead, right? It could be to say the size of the customer, number of employees in the company, geography, right? You can use your own persona of what is a right qualified lead and define that. Number of activations. Of course, if there are people who are leaving, it's very important that you pick up ideally you are able to talk to the person and somehow show your puppy face and then get them to talk to you before they leave, because that churn feedback is gold in the early days, right? Otherwise, at least create a good survey that is less, it should not have friction, but at the same time, you would want to have answers for churn metrics. For us, we learned to ignore 95% of the churn that was happening in that stage, but we put all our effort in 5% churn that should have been avoidable churn, because the avoidable churn tells you so much about which features to build. So these are some of them. So a good, if you are actually talking to a venture investor, my recommendation is definitely focus on MRR, qualified leads, and you are now ready to scale. But most importantly, demonstrate that you are also able to, the problem resonates with the customer, which is why it's very important to think about product engagement metrics and showcase product engagement metrics very clearly. However you define it, right? Whether it's active users or money processed or number of invoices generated, it could be anything for you, right? Or number of tickets created, any of that. So some of these would be the ones, it's up to us to define the story, right? Because ultimately it's an early stage company. You're going to sell the problem to a venture investor, right? The problem statement and why you exist, and why this solution will create that wow moment. And then when you are actually demonstrating the numbers, you can lead them to a place where you build your story, and more importantly, focus on these types of metrics rather than the ones in the next slide, which is, don't focus too much on LTV, churn rate, CAC payback, and all of that, because it doesn't matter, especially churn rate. No, right? Churn reasons are more important than churn rate in the very early stage. I would say you should have if you have 10 customers who have churned out, and if you have good feedback, you should actually write it down and then say, how are you going to mitigate that? It could be something like, okay, I don't have the features, so the customer churned out, or this is priced too high for them, so I'm going to iterate on the pricing. You will also know how you are going to handle every one of those objections, and it feeds, and it also demonstrates that you are really learning from the market and the customers, not just the ones who are using the product, but also from the ones who are leaving. So I think by shifting the story to things that really matter, I think we will be able to craft a much better story. I think I'm telling all of this in hindsight, making enough mistakes, as well as what I wished I had also done a lot better. But thankfully, we had investors who would always ask first principles questions rather than some of these compound metrics.
That's awesome. Super helpful. And as a reminder to everyone watching, I know a lot of people are asking for these slides. The replay will be available right here on Crowdcast, on LinkedIn, and we'll also have it on our YouTube channel. And we'll make sure that you guys get a link to the recording so you can kind of come back to this stuff. Next question. Another question from Rebecca, similar to before. What key metrics do venture capitalists compile in due diligence work before investing?
So this is possibly a seed stage or a pre-series A. Is that correct, Casey?
Yeah, I'd say that, yeah.
Right. So one of the, I think every investor generally thinks about, I could be, this comes from, I think every investor at every stage of investment, they always think about, hey, is there enough market size? So market size is something that you should definitely put a lot of effort in terms of trying to gather as much information as possible. That's one. So we bootstrapped the company, so we really did not do market sizing work properly at all. And the category that we entered into did not, except one IDC report that was created probably in 2012 for recurring payments, which was not even very large. They did not say the market was large. They actually had old school systems referred to it. And we couldn't prove the market size in a way that we could say, hey, there are going to be a lot of SaaS companies and we could sell to SaaS companies. The problem was, in 2012, pretty much everybody was like, at least the investors I was talking to were, but how large is SaaS going to be? But today we know that there are a number of companies that are built only for SaaS companies and still can build billion-dollar companies, valuation companies. But when you do not have that proof point through an analyst report or something else, you have to think about all the other data points that are important. Because if you think about how the investor makes a decision, there are two things. One is the investor wants to build conviction that the problem exists in the market and you have a great team with which they can work. Now, the third thing is they are going to pass on everything to an analyst to do the diligence so that it will back up their gut feeling and the hypothesis. Now, what is the analyst going to look at before they validate? So it's not any of these metrics which matter, like LTV, churn rate, and all of that. But rather what matters is there a lot of market demand? So I would urge you to say, if you are going to build on inbound, look at all the competitors, compile a list of all competitors. Don't ignore them. And then even if it is an adjacent space, think about how are they acquiring customers? Spend a little bit of money on Ahrefs or what is it? The SEMrush, one of those SEMrush or one of those products that tells you everything about the AdWords of even the everybody spend. Then go to Google AdWords and then use the keyword. They have this utility for searching the keyword volume by geography. make a list of all those keywords, and then find out the volume of keywords, the search trends, and how it's actually going. That data is gold with respect to, you have done your homework and you know that the market exists, right? So try to find out everything that backs up what an analyst is going to tell a VC, that no, there is space and there is disruption happening, and this data also proves that. Right? Think about all those metrics and put that in the data room, and then everything else is hygiene, right? Which is basically the rest of the metrics are hygiene, like tracking your MRR, product metrics, and other things that we already spoke about. If there are other things that I would add, it's mostly the make the life of the analyst easier by making about the market and more about the problem than anybody else, right? So you should actually have done more work on the competition. Don't try to ignore them, rather embrace it, but you don't want to hero them. But at the same time, you definitely want to make sure you are taking a honest view of the competition. How large are they, right? Do your homework with respect to how much funding they have raised and all of that. Put that in a sheet and then make sure you compile and provide as much data to the analyst and help them out. Is this something in line?
Yeah,
or
definitely. Yeah, I'm just checking in on our comments on LinkedIn because there's a lot of interest in what's happening. So there is a question kind of related to that I'm going to skip to the bottom. And they ask, are the total addressable market, service available market, and share of market important to track for early stage businesses?
Right. I wouldn't put a lot of emphasis on the share of the market, but definitely total addressable market and serviceable addressable market are things that I would definitely put a lot of emphasis on. Two ways in which you can do it, right? You can do your own bottom-up analysis to say, hey, if you are building for, let's say, e-commerce companies, you can say Shopify has 1 million e-commerce stores, which are small. And out of that 1 million store, how many of them are, let's say, under $1 million in revenue per year, right? Go study their public data, right? Because they are a public company, they are publishing data all the time, and then you will be able to do that, right? Or look at some analyst reports, because investors who are going to put in money in those companies are already publishing reports. These are all available. I would say do some of that and then form your hypothesis, but at the same time, be very judicious to think about is your entire TAM is not your serviceable addressable market, because your product is going to evolve, and every time you build certain capabilities, you unlock more of your market. So if you're building a product that's very relevant to sub 1 million companies, then out of the million stores, if 500,000 of the e-commerce companies are addressable to you on Shopify platform, then you say, I have integration with Shopify as a platform. I don't have integration with BigCommerce, Volution, WooCommerce, and everybody else. So all of that, even though it's part of that TAM, it's not part of my SAM. Ignore that. Then within Shopify, my 500,000 companies, which are under $1 million in annual revenue, is my serviceable addressable market today, right? So my first 1 year, this is going to be my serviceable addressable market. I establish my beachhead here. Then by the time I build this integration, this capability, then my other 500,000 of companies will open up in 18 months. Then suddenly this happens. Then I build the integration into BigCommerce. Then I build my integration into this. Then my serviceable addressable market opens up. The more pragmatic and practical you are about the approach, the well thought out it is, I think you are demonstrating your maturity to the venture investor by actually talking about this in very practical terms. Right? You can be, of course, aggressive about timelines, and then if I am given more resources, right, if I had the money, then I'm going to build more connectors faster. So my serviceable addressable market will expand faster. But you could do that. And that demonstrates use of money, right? Otherwise, I'm going to bootstrap my way to profitability. So I'm going to start with one, right, and then do this. Or I'll hire 4 more developers and do this faster. Something like that.
Great. Next question from Tamara. Determining pricing structure is of interest, especially when providing a new service. Start with a freemium offer initially, then add new features and charge. But how do you determine the tiered pricing?
Okay, I want to make sure I understood the question correctly. So feel free to correct me. So the process of building this is you would have a feature set and you would have a freemium, right? So the question is, how do you do this small feature set for freemium and define your value metrics or the feature set for your paying customers. Is that a fair understanding?
Yeah. How do you determine that pricing as you develop new tiers?
Right. Okay, got it. I would say I'm going to ignore the freemium part for a moment. Right? When you think about, let's say you launch your product with $99 base tier, and then your next tier is a $299, and then let's say $999 as your highest tier. Now, when you start and launch, your $999 is just a what do they call it? It's just a reference point. You probably don't have enough value built into it yet, right? You probably have enough value built for a $99 product. So which means that you would load up more features into this plan. You use probably $299 as an anchor, right? So that even if there's a customer who comes in and then they find more value in the $99 plan, they would go with it. And then they'll think, okay, for these two features, I'm not going to pay $299 yet because I don't need it yet. So I'll go with this, right? And they may choose it. But another trick is also to think about service level that is needed, where somebody, if you are building some critical service and they want on-call support, you have a $99 plan with basic features and say email-based support. You could introduce a $299 plan and say, okay, I will also offer phone-based support along with email and chat support, right? Within the real-time chat support and phone support, callback. Now, suddenly, businesses that value and consider you to be a premium and very important application would start paying you $299 because it's very important for them. Now, this mental model is also the same way that you can think of additional features. I'll give you an example. For us, very early stage companies do not have an accountant in-house at all. Most of the time, you would outsource your accounting to a very small firm outside. And we used to have QuickBooks Zero integration in the freemium tier. And the problem was most founders are not knowledgeable in accounting at all. So even if they set it up, they would actually set it up wrong. And it results in more customer support and also issues and all of that. And so it was not a feature that was useful when you're also not making revenue. So why load up that one plan with more features? So what we did was we started separating these features into thinking about what does the customer go through. The customer has to have at least some level of revenue before they take advantage of the features. So we started, it's more like a soft limit. So we moved some of these features into a higher tier and then said, in your pro plan, we will have the accounting integration. And by that time, the onboarding setup and support is also necessary for an accountant. They have hired one person, and they also have somebody knowledgeable to make use of it. And it turned out it was actually right. It was a good decision. And so you can iteratively move these features like this. And another way you can do this is based on price point. For example, if you have a NetSuite integration, why would you put that in a $299 plan when the customer is paying $30,000 minimum for that product? $30,000 or $45,000 per annum to that product, right? So it doesn't make sense because this is a company that can afford to have even an individual available to even set it up, right? They have to pay and have a person to manage NetSuite, which means that you should at least be putting it in your $15,000, $20,000 ACV plan, right? So think about which integrations, what other product they are already using, right? What could be the size of that company, stage of that firm, customer who are using your product, and then try and put your features in the right bucket that makes sense, that makes it more attractive, and they will also assign value to that feature.
Awesome.
Maybe one more example, maybe, if you don't mind. HubSpot, right? They used to qualify, I think few years back before they introduced the $50 freemium tier and all of that, they used to have only the $200 entry-level plan, $800 mid-tier plan, and then another plan that started at $3,200 per month or something. And they deliberately used to move the features like Salesforce integration only into $800 plans. And then they also added something like a $3,000 onboarding fees in this plan, and they would throw in 10 hours of consulting setup time to ensure that to qualify the customer. Because at that time, they wanted to make sure the product is sticky, and it was sticky only if you were fully committed to the market, to using the product. And you needed a HubSpot trained person to get the most out of the product. Otherwise, it was resulting in a churn within a year for them. So they deliberately put a qualifier, a setup fees as a qualifier to know that the customer is serious about it, and they can put in more effort into offering some additional service to make it successful, set it up correctly. And if it is set up correctly, then they are going to be more successful using the product throughout the year. So think about the customer journey, and then how much value they will assign to this, and then move your features across different parts.
Awesome. I like that.
Casey, how are we doing on time?
We are good. We probably have about like 15, 20 more minutes. So go ahead and get your questions in. We have a few others to get to. Let me see. Okay. This one came in, it's pretty specific. So if you don't have any specific answers, it's fine. But they said, what would be a good metric for a biotechnology startup launching diagnostic devices?
No. I'm terribly sorry. I'm not an expert on that topic. But if you can drop me a note, krish@chargebee.com, maybe I can connect you with fellow founders or one of our customers who may be in this space who can help you better. Right? I don't want to lead you down a path where I don't have any expertise.
Great. Yeah. Biotech can be hard. All right. Next question. And a viewer on LinkedIn wants to know, how did you validate your MVP before even building it full scale as solving a problem in the market?
How do you validate your MVP even before fully scaling your product, right? Okay. I'm trying to connect that with some of the earlier things that we were talking about, and also trying to relate to that to our journey. So when you think about somebody like if you close your eyes to think about the existence of HubSpot as an all-in-one marketing software, and then there was also space for specialists, right? Like a buffer that said, hey, let me help you schedule the tweets and social media. For HubSpot, it was a feature that they did not even prioritize for a very, very long time. They never built it. And if you are the buffer in that market, how would you think about it, right? There is one acute pain and you know that the problem exists. It's not solved by a big product. And I know this problem exists for a certain segment of market. And you would actually go after that to know that, okay, validating that problem with the customers, and you would test for the excitement of the customers to purchase your product just for that, right? Would a HubSpot customer purchase a buffer at that stage, right, when they did not have the feature? I think is a good way to think about it. There are companies, I remember one of our very early customers, very successful company, Schedugram. In the early days of Instagram, I used to think, okay, so what is the use of this product in a B2B space for somebody who was going to build the scheduling and managing your Instagram? And I thought, okay, what's the use case for a B2B? It turned out that the product was very much used by agencies and businesses that wanted to have a digital presence, and they had a lot of Instagram followers, and they could actually acquire customers through Instagram as a platform. And then, so all these businesses that were trying to, let's say, think of a restaurant or somebody else who wanted to put pictures and all of that, or a travel agency, they could actually post many of these things and schedule the what do they call it, the photos in Instagram. And they were actually building a software only for that. And these businesses were having a very particular need, which was not solved by any of the digital marketing software. So if you are building something like that, which is a minimum viable product that solves one problem really well, first validate what else are they purchasing today, right? And who else actually has an offering that actually looks very broad and might eat into your space. But at the same time, it's just a small feature, and yet they are not going to prioritize it because it's only for a narrow segment of companies that is not too important to them today, right? And that wedge is what you're looking for whenever we build MVP, because every category has at least 5 to 10 companies that are large, and then there are going to be 50 others who are small companies that are building. So it's not like there is no competition, but every time our MVP comes from as a founder, our deep understanding of one particular problem and a unique understanding of an opportunity, right? And we have the conviction to believe that that is possible. Like there could be a particular company that is an equivalent that is extremely popular in North America, but you might believe that if I build something that is very localized for brick and mortar stores in Europe, I know that there is a market for it. Then I would say don't try to go after North America to validate the product. Go to this local market where you add tax capability or something localized for Europe, and then validate it in that market where you find the wedge in the market, where there is a gap. None of the competitors are solving that problem. The most important problem that's very painful for the customer, I would say validate that. I hope that answers the question.
Great. Great, thank you. Next question, should we change our metrics as we grow? So
Absolutely.
If a company, is growing, and getting further in their startup journey, how should they think about their metrics?
Sure. Can we look at the slides if you don't mind?
Yeah.
Right. I would say, let's look at yes, right? So initially we defined this as stage 1, stage 2, stage 3. We looked at the stage 1 metrics. Can we look at the stage 2 metrics? The next slide, please. Sorry, the previous one.
Oh, there we go.
Right. So the moment you actually have product market fit, of course, a lot of things change, including from tracking your recurring revenue, right? It's not just the ARR that you track. You also start tracking your churn rate, cash flow, right? Because the cash flow is very, very important to track because we tend to ignore it. But it's very important to track that. Net dollar retention rate is something very important to track. And do that because you would want to know, even if you are not able to track the net dollar revenue retention, my recommendation is at least to track the usage metrics of the customers if that is actually increasing and which vectors are increasing. For example, it could be, let's say customers are using more and more of this one feature when their usage is growing. And then you will learn that I can actually price my product along that vector, right? It could be that, for example, if you're building a Typeform equivalent, then you would want to know how many surveys are running, right? Or how many responses are coming from customers, and or how many forms how many forms is every user creating, right? It could be any of that. Track that and also track the retention metrics of those. Because if that usage deteriorates, then you have a problem, right? So you would want to, apart from tracking revenue retention, you should also track your feature retention metrics. And then, of course, CAC payback by channel. And as you continue scaling, you would also want to track the sales cycle, win rate, and all of that. Deliberately start going into qualified leads. How many of them are becoming opportunities? How long does it take before it becomes an opportunity in your CRM, right? Or whether you do a CRM or an Excel sheet. And then how long does it take for me to sign a contract or get the customer to pay the first dollars, right? And the win rate, right? How many leads, how many opportunities, and then how many wins, right? And look at it as a cohort and then form some hypothesis about your win rate and other things. Don't shy away from looking at the data because it might look bad, right? Because it's okay, right? Early stage, and even when you are getting into the next phase, many of these metrics are going to be a little messy and then here and there, but it's very important to track it diligently and then want to look at it carefully. Another one I would urge everyone to look at, especially from stage 1 to stage 2, is onboarding time. Because early on, you do non-scalable things and then handhold the customer, onboard them. But by the time you are actually scaling, it's very important to measure the onboarding time. From the point of sign up and trial to getting the full value of the product, how long does it take? How long does it take for them to integrate? How long does it take for them to set up an integration? Measure every one of these and track that, because those are areas where you would want to improve. Because the moment you're going to hire more people and then give the problem away to them, as a founder, you have to do that. Then it's going to get tricky for others to be able to build on. They're going to build on your foundation, right? So tracking some of these things are really, really helpful. But with another stage of maturity, when you go past the $10-20 million, can we look at the stage 3 metrics, Casey? You don't know. Yeah. So at this stage, I would say ignore the gross margin quick ratio, but you can actually start measuring some of the compound metrics as well, right? So it's an addendum, right? Whatever you measured, and then the stage 2 metrics, and now by the time you get to this stage, then you would also add many of these metrics. These are all some of the slightly compound metrics your finance team should be able to help out. Things like the reason I'm saying compound metrics is look at something like a GEI. It actually, this one metric will tell you the efficiency of your machine. How much new ARR are you winning every month if you are winning, let's say, $100,000? And how much are you having in operating cash into the machine to generate that $100,000 of new ARR? If this ratio is skewed, then you have a problem, right? You're going to quickly run out of money. If it is actually healthy, right, like a metric like 3 to 5x, then it means that if you are reaching 5x, you are going to get profitable very quickly, right? So some of these compound metrics are really, really helpful to measure. These are some metrics I would say. This is how it evolves by stage.
Great, awesome. I will go ahead and leave that up there just for a little bit longer for people to digest. All right, let me see. And the last question I have here, we talked a lot about metrics. We have all these things that people are now going to be tracking, especially as they grow. Are there any systems or platforms that make it easy to keep track of metrics?
I'm going to answer that, keeping in mind the stage of the companies, right? I'm again sub 1 million. My recommendation would be simple systems, right? All the way from, let's say, if it just has metrics, right? Shameless plug, if you're using Chargebee, we have revenue story, and we also have Bear Metrics or Chartmogul, Profitwell. These are products, analytics product that allows you to keep track of your subscription analytics and metrics. That's one. But you should also track a lot of other metrics, which, see, there is a customer of Chargebee that I really like, this company called Simsas, SIMSAAS, Simsas, who's actually helping modeling a lot of these metrics. That is especially for early stage companies where you pull in data from multiple sources and do your, you can look at all the metrics in one place, especially the revenue planning and other things. So that is also very good. My recommendation is don't go for something very complex. If you have outsourced your accounting to somebody, you can also request a monthly MIS, feed them the marketing data and also your sales metrics data, provide them with raw data, create a template, and then ask them to just give you a monthly simple Excel sheet, consolidating many of these things. I think that is also a good hygiene factor is more important, and how frequently we look at the metrics is more important than a lot of systems, right? Sorry, it's I'm answering the question differently, but it comes from practical challenges of looking at the right metrics and having the hygiene of actually reviewing the metrics with the team, where you allocate at least 1 hour every month at the beginning of the month to say, hey, let's look at the metrics, sit down and look at the metrics without wanting to avoid any bad news. I think is very important, because as founders, we have this thing of we know what's bad and we try to hone in on what's working well, and then we build our story around it, right? And that's the only way to stay positive in the early days, to make sure that we keep going. But at the same time, it's very important to build the discipline of looking at everything, even if it is just spreadsheet. I think that is more important, and learn to just look at numbers objectively and take stock of the situation using through numbers, right? Just wear different hats, and then without emotions, just learn to look at it and then question it as if you are an investor, rather than trying to say, this month I know that we did not get enough leads, so avoid that. And then you look at, okay, everything else that's working well is not a good idea. I would say standardize the template and always look at it month on month, and then just sit down and question everything with your co-founders.
I kind of laugh when you mention that, because I think, a lot of people will probably relate to that. You don't want to look at the negative things or the bad things, but it is important, right, in the story and when figuring it out.
Hey, it's about survival, right? Early stage, we run on some form of conviction and belief, and most of the time that encouragement that comes from that one customer who light up and says, okay, I like your solution, right? And these metrics are exact opposite of this, right? This is all bad news whenever you are not able to demonstrate that through numbers. Then we demonstrate everything through stories, and that's natural and that's fine. But at the same time, I would say, at least privately, sit down and then look at it regularly.
Great. A question came in about one of the services on the tracking app. does Simsas help track operating data for digital payments tech businesses?
I'm sorry, can you repeat that? Does Simsas track, is that the question?
Yeah, does Simsas help track operating data for digital payment tech businesses?
Digital payment tech business. I'm not so sure. I can connect you with Simsas founder because he's building it in public, right? Still an early stage company, and I'm guessing there are multiple other competitors or probably mature companies in that space. But Simsas is one that I like because they are a customer, and I've been following the founder building it openly in public. I can connect.
Great. Yeah, and we can also connect these links. We'll gather them from Krish and his team and send them out to all the attendees afterwards. So we can always connect that too. Great. So that is the end of our questions, Krish. Is there anything else that you would like to tell all the founders here on Crowdcast and LinkedIn?
I think if there is one thing that I would again and again urge, because it's a crucial lesson for us that helped us, was again and again go back to first principles, right? These metrics and everything else is great, but if there is one thing we should definitely focus on, objectively question everything about the customers, right? If you're having 100 customers, find out which are your best 20 customers in that. And then if you ask the question of who are my best 20 customers, and for my next 100, I want them to be similar to this 20. Who is that? Right? I'm pretty sure if you have 100 customers, not all your 100, you wouldn't want all the 100 to be your next 1,000 customers, right? You would definitely have some of those 20, 25 customers that you would want more of. Who are those? Write it down. Objectively, try to define the trades, why they like your solution and what alternatives exist and all of that. These are first principles thinking activities. Nothing related to numbers, but these are the ones that actually tells us if we are building the right product for the right customer. That I think is more important as you get to the first million, because once you nail this, as you get to the first million, then the flywheel gets going, and then going from that 1 to 5 in 1 year, or all of that is possible. The flywheel gets going only if you have the right type of customers and get more of them. If we actually get too many customers, it's too much standard deviation, what happens is we spread ourselves too thin after the first million. Then a lot of things get stuck at different stages. Then going from that 1 to 3 or 1 to 5 gets harder. That's why you need a homogeneous set of customers, of similar customers, to get that flywheel moving, is my one piece of advice.
Awesome. Thank you. I also linked in the LinkedIn chat in here in Crowdcast a link to a recent article that Krish wrote talking a lot about these metrics and other metrics to track in your startup when starting out. And so I want to thank Krish and Chargebee for helping all of our founders on the call and on LinkedIn. We will send the replay around afterwards. You can check the replay out anytime here on Crowdcast. It will be up on our Techstars YouTube channel, and also you can head over to Techstars LinkedIn and watch the video there. So thank you, everyone, and thank you, Krish, for joining us.
Yeah, thank you so much. It was fun. Thanks so much, Casey. Bye.
Bye.